BSE dips 6% after the NSE shifts its weekly expiry date from Thursday to Monday. Analysts say that there is a possibility of some volumes moving from the NSE to the NSE from the BSE.
Coforge rallies close to around 9% after the company wins a 13-year deal worth around $1.6 billion. The management also announced acquisitions of two companies, and the board has also approved the stock split to divide the equity share into 5.
Oil marketing companies like Indian Oil, HPCL, BPCL, all of them up anywhere between 2 to 4% after Brent crude prices fall, dipping to a 6-month low, Brent below $71 a barrel.
Adani Wilmar climbs 5% after the company announces acquisition of Topps ketchup and sauces maker GD Food. The company is set to acquire 80% stake in GD Food at an enterprise value of around 600 crore rupees. Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel and with me is Mangalam. Well, let's get straight to a couple of managements that we have lined up. Senores Pharma, that's the company on our radar. The company recently acquired close to around 14 abbreviated new drug applications from Dr. Reddy's. The company has also began manufacturing at its second API manufacturing facility. To discuss this, the revenue growth outlook, as well as business outlook at large, we're joined by Mr. Swapnil Shah, the managing director of the company. Hi, Mr. Shah. Good morning, and thanks a lot for joining in. Well, congratulations on this acquisition with regard to this, 14 ANDAs that you've got on board. Could you tell us what kind of revenue potential does it have for you? When does it start flowing in? And for this year, what kind of a revenue number will you end at?
Thank you. Thank you very much. Good morning, everyone. So this 14 acquisitions, the A&D acquisitions that we have done is going to strategically put us for next year and year after growth, in terms of, because there's a lot of tech transfer will happen and product will start getting manufactured from our US manufacturing plant as we speak. This year, we are expecting our revenue to be around 400 to 420 crores, which was guided earlier as well. And with a decent profitability that we have seen in our first half and our Q3 results.
Okay. So how much will these 14 ANDAs add to your revenue over the next couple of years? If you could give us numbers. We have the total addressable market out there, but what we need to understand is what it does for you. And secondly, how much are you paying for these ANDAs, 14 ANDAs that you've acquired?
So the market potential for these 14 products ranges from, say, $400 million to about $1.1 billion, depending upon what channels you are looking at. Because these products have a lot of potential in government business, specialty clinics, direct patient management clinics, and so on and so forth. So a lot of this data doesn't get captured in a lot of IQVIA databases that we look at it. So between 400 million to 1.1 billion is the total addressable opportunity, out of which, as and when we get to launch each product in the marketplace, I think it is difficult to pick a number, what kind of opportunity that it holds for us. But okay. I would say it's a significant milestone for Senores Pharmaceuticals, and it will significantly add our profitability as well as our revenue numbers going forward in the next 2 to 3 years.
We're looking for numbers, sir. If you could help us out with that. So for this year, you've said 400 to 420 crores. We have taken that number on board. For the next year, what kind of a revenue number can you give? And particularly, I want to focus on the CDMO business, because that seems to be the key driver for the stock. As of last quarter, it was close to around 11%. But I believe far more approvals have come in there. And because of commercialization, you're looking at a bigger chunk out there. So what is the revenue mix coming in from CDMO? And since you have a lot of these, you've got the green signal for a lot more products out there, what can it contribute as a percentage of your total mix, say in FY26? Please go ahead.
Yes. So next year, we are looking at about 700 crore revenue, plus minus 5%. Our profitability will largely remain same, or it may get improved because of operation efficiency. And on the CDMO side, next year, I think our mix is going to be almost, say, about 35 to 40% on the CDMO side. Again, our CDMO space is largely on the government side of the business, controlled substance. We are working on a couple of NDA products as well, which we work with innovator, so to speak. So that will drive our CDMO, CMO growth next year onwards on more profitable opportunities and the product that we have.
You haven't told us how much you've paid for these 14 ANDAs that you've acquired.
So we are actually under definitive asset purchase agreement. It's highly confidential. What I can tell you right now is the deal that we have struck with Dr. Reddy's is win-win for both, for them as well as us, because we are looking at a different marketplace as we speak. At an opportune time, I think we'll disclose the acquisition cost for these 14 products.
You know, the reason why I ask you this is over the last few years, you've been acquiring a lot of companies. I look at your borrowings as well. Borrowings have increased from what? 15 crores in FY22 all the way up to 250 crores in FY24. If you look at your fixed assets, that have also increased because of these acquisitions, largely led by intangibles, which are now about 80 odd crores of your total fixed assets. Last year's, asset turnover was sub 1. So what we're trying to understand is how much can you scale this business? And secondly, while you are making sales, the money is not coming because debtor days are at still 191 and the operational cash flow, it's been negative for the last 3 years. We want to understand these factors.
Well, two things you have to look at it. It's a high growth company. That's point number one. Point number two is whatever those financial numbers that you are seeing, that is a result of consolidation of multiple companies, right? So I think this year, post-March numbers, you will have a clear picture in terms of where it stands, because of a lot of those numbers are because of the consolidation that have happened. That's one point. Now, coming to that, we have paid about 90 crore odd debt from IPO proceeds that we have. From operating cash standpoint and the number of debtor days, I think one portion of our revenue is little extended, say about 180 to 210 days. Remaining out of all our revenue streams, we realize our cash flow within 30 to 45 days. So we are working on it to improve that one component where it's a slightly longer cycle for us. And we are already talking to bankers as well, our customers, to see how we can improve on those cycles as well.
What is the debt in your books right now?
Sorry?
What is the debt in books right now?
So right now we see about 140 crores or so after 90 crores that's been paid.
So 140 crores is the pending debt after repaying 90 crores. Is that correct?
Yes, that includes our working capital debt as well. It's not just the long term, right?
Operating cash flow turns positive in the next fiscal?
100%. It's already positive as we speak.
And do you have any need to come to the market to raise any more money?
No, not in near future, at least not in possible future.
Over the next 2-3 year period, what would your fixed asset turnover be?
Difficult to say right now, but we can, during our earnings call post completion of this year, we can address that issue.
All right, we take that point. We'll hold you on to those numbers. Thank you. Congratulations on this acquisition. We'll obviously keep awaiting the launch and the kind of addition that happens to your revenue because of these and all the other acquisitions that you've made. With that, we'll shift into our special segment where we get you a few ideas for profit coming in from our colleagues at Money Control Pro. Bharat Jinani joins in.
This is with Goldiam International Limited. The company posted strong Q3 results with revenue growth of 40% YOY. Looking of pending sales from the previous quarter, as well as festives in the key market of United States, led to a strong performance for the company. Lab-grown diamonds are continuing to gain traction for Goldiam, with their sharing revenues increasing from 60% in Q3 FY24 80% in Q3 FY25. Operating margins improved by about 230 basis points, driven by operating leverage and better mix. Lab-grown diamonds are continuing to gain traction globally. This is because although they have same look and properties as well as compared to the natural diamonds, but they are about 75 to 80% cheaper as compared to the natural diamonds. Also, lab-grown diamonds are more environmental friendly as compared to the natural diamonds. This trend is positive for Goldiam International Limited. The company is gaining market share in the key market of United States with the launch of new products. The company is also tapping new geographies of Middle East and Australia. The foray of lab-grown diamond retailing in the Indian market is an important trigger for Goldiam. The company aims to open about 20 to 25 new stores in the next 1 year. This is likely to give it a first mover advantage in the Indian market. At the current market price, stock is trading at a PE of 32 times FY26 earnings projections. Investors with the long term view can add the stock.
Right, with that, we'll slip to a short break. Come back on the other side. We focus on the quick commerce plays. Karan Taurani of Elara Capital will join in to discuss the trends out there. Yesterday, those stocks were doing a little well. Let's see how things are panning out in that space. Welcome back. Quick commerce companies are on our radar. Over the last couple of trading sessions, there has been some, commentary around it itself. Day before yesterday, we had Ramdev Agarwal talk about how quick commerce companies may continue to create value. Yesterday, there was a note that came in that suggested that maybe competitive prices or discounting, the peak of that is behind. And as a result of which, we did see some up moves in the names like Zomato and Swiggy after these stocks had taken a big knock from the top as well. So to discuss trends around this space itself, Karan Taurani of Elara Capital joins in. Karan, a lot has been spoken about, a lot has been written about over the last couple of trading sessions. These stocks have also seen a bit of a decline. From the lows, one, what is your view on these stocks? Secondly, your view specifically on quick commerce profitability. Have your channel checks suggested that the worst of competition is behind?
Hi, Mangalam. Good morning. So I think we largely maintain our view that quick commerce, as a business proposition, is supposed to see very strong growth rates. In terms of competitive intensity, we have got e-commerce players, which have entered this market right now. But quick com and e-com are both very different propositions, as we pointed out in the past as well. I think, in terms of product assortments, in terms of dark store, in terms of economics, the people, the supply chain, the strategy, both are very different things, very dynamic in nature. E-com can enter Q-com, but e-com cannot displace the existing players of Q-com. So I think market leaders like Blinkit will continue to have an edge here. You will see price wars to a certain extent. You will see discounting happening by the likes of Zepto and Instamart. But I think quick commerce as a business proposition is here to stay, and it's quite disruptive for the entire ecosystem. Second part, in terms of the preference in terms of the stocks, Zomato versus Swiggy. What we've seen right now is that, Swiggy valuations have kind of come off by 25-30% over the last 3 to 4 months. And that's primarily been, because of the kind of premium valuations they were trading at. I think the discount for Swiggy versus Zomato even right now is about 60-odd percent, 65% in terms of absolute market cap. And given the kind of scale, Swiggy operates in terms of the food business and the Q-com business, and given the kind of hefty losses Instamart is making today versus Zomato, I think, Swiggy is more of a tactical trade right now. We would probably, bet Swiggy in terms of having an underweight stance over there and maybe allocate 20% of the funds on Swiggy, but still a large chunk of the allocation would come to Zomato because firstly, it's a safer bet. And in these uncertain times, I think you have to play with market leaders. Blinkit has shown top-notch execution in the past with the kind of work they have done in terms of expansion. Even right now, if you see in terms of losses, they are phenomenally low as compared to peers.
All right. Hi, Karan. Good to see you in as always. Karan, so you're saying that the 60% valuation discount will continue to stay for Swiggy versus Zomato. And also you're saying if you're allocating money, 20% as a tactical bet would go towards Swiggy, the remainder will go to Zomato. Is that correct?
Yes. So 20% bet would go to Swiggy, 80% the higher allocation will still be with Zomato. I think the discounts will still remain because in terms of Swiggy, what we've seen, the quick commerce growth rates have actually improved over the last couple of quarters. But, this is coming at the cost of hefty discounts, right? So I think Swiggy, Instamart need to do really well in terms of any kind of a business parameter, kind of reduce the losses from here on to actually showcase a better premium valuation multiple versus Zomato, which is why I think we believe that, just doing a price war, just giving hefty discount is an easier way to gain market share. And I think Blinkit will continue to have an edge here because Blinkit losses are extremely low as compared to what Instamart is reporting today.
Right. So that's as far as quick commerce is concerned. A large part of the SOTP also comes in from the food delivery business for both Zomato as well as Swiggy. And now their growth rates have been slowing down. Even though Swiggy on a reported basis was slightly higher than Zomato in the previous quarter, that was also on a lower base. This coincides with quick service restaurants actually seeing a lot better traction with a lot of people, looking at the value offerings that those guys are making. Is there any concern over the growth of food delivery itself? And what's your view on quick commerce, quick service restaurants?
So in terms of the food delivery segment, I think this segment is reasonably penetrated right now. What we are seeing right now in terms of quick commerce, there is ample opportunity to penetrate more in terms of a larger customer base going to non-metro markets. The food business is, kind of matured to a certain extent. So growth rates, I think, will remain in the range of 18-20% in terms of GOV. I think, what has happened that the competitive intensity in the food business is extremely low. I think the players themselves are not trying to focus on user acquisition and user growth because they know that there's no large competitor which is going to come in. In fact, we've seen direct ordering platforms make inroads into food business, but they mostly shut down. So I think the focus is, more in terms of profitability, more in terms of margin levers through advertisement revenue, platform revenue. I think margins will continue to see a positive surprise as far as food business is concerned because it's mature in nature and there's no threat of new entrant as such. And it's a deliberate move, by the companies to focus more on frequency, focus on AOV, and focus on profitability. The second question, what is the second question? My second question.
The second question was, what are your view on quick service restaurants?
So on the QSR piece, I think very clearly what we are seeing right now, the delivery channel is quite encouraging. Delivery-based players are doing well. But even from a dine-in standpoint, I think the worst seems to be over because in terms of SSG, we may not see positive SSG in the near term, but I think the SSG is also kind of bottomed out as far as decline is concerned. Second respite is that margins also from here on could not, go below a certain level because discounting is also come off in the QSR piece. So I think dine-in will show signs of mild recovery, but delivery-based players, players like pizza category, which have got a high exposure towards delivery, will continue to perform on growth as well.
Okay, very quickly, the SOTP of Zomato, could you tell me what is the valuation you have ascribed to businesses like District and B2B verticals?
So if you look at District and B2B verticals, Hyperpure is about 2.5-3 times CV sales, and the District business is about 2 times CV sales. So if you do the back calculation SOTP, the quick commerce business is available at 2.5-3 times CV sales, which is very, very compelling right now.
All right, we take that point. Thank you so much, Karan, for joining in and giving us an overview on this sector, and we'll keep an eye out on how this progresses from here on. For now, your call is 20% of the capital to be allocated to Swiggy, 80% to Zomato. With that, we'll step into a short break. And as we do that, some good news for all our viewers. India's business news leader, now just a click away. Shortly, you will get that phone come up where you have the CNBC-TV18 app, which brings you in-depth articles, financial world updates, and all that happens in the markets in real time on your fingertips. All you got to do is download that app from either the Apple Store or the Google Play Store. Scan the QR code which is there for you on the screen. It'll redirect you to the link that takes you to the CNBC-TV18 app.
Welcome back. We haven't had a screen like this. All the top indices, they are trading well in the green. The advanced decline ratio as well as positive. Mangalam, it's looking very, very good, at least for now.
At least for now. And if it continues to do that, there was a lot of punt buying at that 22,400 call as well for the time that the Nifty sustains above 22,250. For now, it is holding on. Let's see where we go. The screen looking fairly good. So with that, we'll wrap up on this edition of Chartbusters.
Well, that's right. And the conversation around gender parity and closing the gender gap is evolving. And so are the solutions. HSBC presents CNBC-TV18 Future Female Forward Mega Summit, co-presented by Cognizant, where industry pioneers share their take on what's next. Tune in for the discussions that drive real change. 10th of March, 5:30 p.m. onwards.